Hello and welcome to the Durham Talents channel. My name is Jesse Durham. For today's episode, we're going to be having an IBC roundtable. This is a concept that I've been rolling around in my mind for a while now. And what I've done is I've brought on some mentors, some friends, some titans in this space to come and have a conversation to share best practices, frequently asked questions, case studies, whatever it is that they'd like to bring to bear. But I have some things I'd like to run by them, both for my benefit, and I know it'll be for yours. So I hope that you enjoy. But let me convey with you guys, and thank you right out of the gate for coming into this vision that I've been rolling around in my mind for a while of an IBC round table. Now, I've already incorporated something like a round table philosophy in family meetings for probably 5 years now, which has been great, but it can always get better and improve. But in this business of encouraging people to consider the idea of becoming their own banker, of implementing infinite banking, I know that I have gleaned so much from everybody on this call and so many more that has really sped up my experience and my learning curve and my ability to help people professionally, but also even in my own personal life. Y'all have all been a great help to me. So I'd been thinking for a while of how to facilitate a round table discussion where we could talk about best practices, questions, case studies, parts of the book that impact you. And I know that y'all have plenty of value to deliver. So this is me saying thank you. And this is me also trying to let everyone know that listens to this information, the purpose behind this. So this is a great opportunity for me to selfishly benefit from y'all's input, y'all's experience, and everything, right? But also, I know that when we get together, there's a lot of value there. So I want to put it out there for anybody who's willing to learn as well. So that's the purpose and intent behind this particular recording and call and conversation. Now, let me jump to introductions. That might have been a long way of introducing everybody to what we're doing here. But I want to do the introductions, or at least kickstart the introductions instead of folks introducing themselves. Now, I will say that everybody on here has gracefully given a conversation at least once on the Durham Talents channel. So if you'd like to know more about backstories, then check those interviews out. That's in the interview playlist. But Miss Sandra, I'll introduce Miss Sandra, and then we'll just take turns introducing each other. Sandra is a mother. She is a wife. She hails from the great grand Republic of Texas. She is a wealth of knowledge in the infinite banking space. She's an authorized practitioner. She's been a great friend to me and a resource to me. We text, we call. She's been a super help to me over the years. So I want to introduce Miss Sandra. Sandra, thank you for being here. I appreciate you.
Thank you, Jesse. Yes, I live in West Texas. Born and raised in Pennsylvania, though. Moved to West Texas about 11 years ago. And yeah, so the country's been good to me coming across the country. I have enjoyed living in both places, and now I get to call two different places home, right? So
Fantastic. I love it.
So,
all right, so here's what. Go ahead, Joe. You see a fellow Yankee. Go ahead. You want to say something?
Yeah. Well, I was going to say it. I think everyone's wondering, are you still an Eagles fan, or are you a Dallas fan?
Am I
or
a
Houston fan?
Oh, you know what?
An Eagles fan.
I'm going to disappoint you all. I'm not a sports fan at all.
That's very diplomatic.
Equal opportunity. There you go.
I love it. Okay. Okay. So Sandra, we're going to come back. No, let's go ahead and do it while we're here. If you would give us, a 1-2 minute history on your exposure to infinite banking. I want people to know, how you came to be here. They can watch the full episode, of course, but give us that 1 minute on how you came to know infinite banking and do it at the level that you do now.
I actually learned about infinite banking by being in the right place at the right time. That's my 30-minute spiel or 30-second spiel. So I used to work for a chiropractor, and my mentor in infinite banking was a chiropractor. So the chiropractor that I was working for, he had been to a conference, chiropractic conference, where he met my mentor and came back and was kind of discussing infinite banking with me. And I He was like, I want to know more about that. That's kind of how I got started. And my husband and I, we've been using infinite banking for almost 12 years now. We have 3 generations in our family who are using infinite banking in their own lives. And we're kind of creating that whole, private family financing, what would you call it? Networking system.
I love it. Such a great story. Everybody should check out that full first episode. Joe, would you do me the pleasure of introducing Becca?
Oh, I would love to. Becca Wilhite. We've known each other for a little while now. She is a Christian, a Texan, a mother, a wife, and an author. If you haven't picked that one up, definitely grab that. She's been a delight to get to know and spend a lot of time with in this footprint. So yeah, she's generally great.
I love that you were able to hold up the book too. I'm a big reader with our children. We have been for years, and I read lots of fiction, right, to them, Bible and different things. But I love that there is something that's good for the adults, but also for the children around infinite banking. We need more of it, Becca. Thank you for leading the way there. You're at the vanguard of written education and exposure to infinite banking. I love it. Thanks for being here. Appreciate you. Let's see. Should I?
I bet.
All right.
Thanks for having me.
No, I won't do it. I'll tease Joe too much. Becca, would you introduce Joe to everybody?
Well, okay. I guess, Joe, we've known each other a couple of years. Like you said, I was trying to think back when he said that. And I would say without reservation that Joe's the smartest person I know. Like especially from a finance perspective. You can pay me later. No, just kidding. No, he just has well, first of all, I think his background really lends to just such a wealth of knowledge. Joe is he has every financial designation just about that you can have. He's a registered agent with the IRS. He has his PNC. I mean, he has all the letters and all the trainings and all the certifications. And so what really struck me when I first met Joe was seeing somebody who has been in all the modern financial circles. And there was something that was still bugging him. And I hate to tell your story for you, Joe, but but when he found IBC, he could see it through that lens of, wow, this makes sense. This addresses the concerns that I had with all these other things. It makes it all work if you use this as the foundation. So that was really, really powerful to me to hear somebody who had his experience and his training say something like that. And so I think that's a very unique perspective for somebody to come from, because I don't know of anybody else in the space that's had so much formal financial training and still would say, this is where you start. So all that to say, he lives in Pennsylvania, has a dog, right, named Annie, a girlfriend named Maria. I have not met Maria yet, but I'm sure she's wonderful. And has just been it's been a delight to get to know him. So you guys will really enjoy hearing his insights.
And he definitely is an Eagles fan, for the record. Awesome. So I cut you short, Becca, on giving so while you're talking, why don't you go ahead and give us your 30-second story in how you're exposed to infinite banking and where you are now, please.
Well, I think I came to this by sheer pride in the wrong way, actually, because I had a friend who had kind of gotten into the insurance space and was talking about some strategy with whole life to pay off debt. And I can vividly remember someone calling me and said, hey, have you heard about this? Like, what do you think? And I completely shut them down. I was like, well, it's whole life, so it's got to be a scam. Like, Dave Ramsey says so. And that's all I needed, right? So the short version is I really heard about it enough to go and listen to her spiel and then wanted to prove it wrong. And came to the absolute other conclusion. So that's kind of how my story happened. And here I am, obviously a 180-degree turn, because now I talk about it every day.
Yep.
So.
I love it. So cool. So neat. And I'll pinpoint this one more time. Sandra saying, being at the right place at the right time. You saying, well, I was just coming after somebody out of spite and pride, and it's so neat. All right, Joe, would you give us your 30, because Becca's done a great job of introducing you, would you just give us your story on being exposed to infinite banking?
Sure. Uh, you know, I was exposed to it through my dad. I don't know where he heard from it, but he actually, I didn't share this on the podcast, but he was the first one to purchase a policy on himself, use it to buy a car, like actually implementing IBC and privatized banking. It's like, and then convince me and my brother to get policies ourselves, and we'll we'll let that slide because my first policy, uh, I wrongfully terminated, but
But it's okay. You did. I'm sure you did
I want to get
something
that
fun
out
with the
early
money.
before you. But and Becca, thank you for the introduction. I would say not unlike Saul's transformation into Paul, I was on a similar almost mission to disprove this later in life, with formal training. And I kind of liken it to, when you're in the airport and you're going through the security, like on one side would be IBC, and I'd keep getting close to it and then like start to disprove it and get away, and keep getting close to it and disprove it and keep getting away. But like it was like a corridor that's leading me to the correct conclusion. Then eventually there was this moment where I had about 1,000 epiphanies in the fourth or fifth time I read the book. Yeah, it's once you see it, you cannot unsee it. That's the truth.
I love that visual
That's
analogy
good.
you gave. That was helpful for me. That's neat. I love it. Okay, so it's obvious now why I asked everybody, and again, I appreciate you being willing to be here. So let's dive in on anything that's sticking out to you. We've loosely discussed topics because what I'm looking for is to facilitate a discussion here. But there are some things that we visit on the regular in talking with prospective clients and people that are vetting this idea of becoming your own banker, as conceived and codified in R. Nelson Nash's book, Becoming Your Own Banker, The Infinite Banking Concept. There are things that we regularly visit with consumers, with clients, with prospects, but also these are things that we've lived out. So maybe let me begin by asking y'all in turn, so you could be thinking about what this would be for you. You didn't know I was going to ask you this, and that's why I like just the organic conversation that I know we're getting into. What's a frequently asked question that, and this could be over your career, this could be, hey, Jesse, this week I was talking with so-and-so. I don't care what it is, but I'd love to hear what a frequently asked question is for you.
What's the rate of return on that?
Should have jumped
Okay.
in. That's what I was
I
going to
couldn't
say.
resist.
That's what I was gonna say too. What are the rates? Those are the questions that come up right away with people. And I don't know, like, I'm meeting Joe for the first time today. I know Becca and we've met before, but I don't know how you all answer that question. But I try to tell people it's not about the rate of return. It's really not. It's about taking control of your finances. Once you have control of your finances, that rate doesn't even matter. I mean, yes, we are getting a rate of return with our, inside the policy, but that's not as important as having control over your money.
I love that answer. And I love that you actually said out loud what I guess I knew was that you don't personally know Joe yet. And again, I think that's one of the benefits of this roundtable discussion is that we are bringing in people where we are getting ready to hear their perspectives, and maybe we don't even know them. And that's just making for good conversation. All right. So, but all y'all were talking about, okay, rate of return, and Joe, you brought it up. So let's give some feedback there then.
Well, no, I was gonna follow up with Sandra. So say you have this prospective client and that's their question. You've said it's about controlling um, the money in your life. Um, I guess what type of questioning or examples or models can you give that might help somebody migrate from fixating on the rate to more along the lines of what you're trying to convey?
That's good. Is that your question to me? That's a question.
Oh yeah, sorry. Yeah, that's yeah.
Okay, is he asking me that question? So yeah, so like I'll use my own examples. Like when my husband and I started using infinite banking, we had debt. So that was one of the first things we wanted to do, was get control of that. And once you're once you realize how much, interest that you're paying out to third party creditors, and you're able to recapture that, you start seeing more money in your own hands, and more money in your own bank accounts, and inside your policies, and those type of things. And by recapturing our debt, we were able to kind of, turn things around for ourselves. And so I just tell my own story about how, when we were able to kind of pull that debt back over, where we had control over it, and we had control over how we were going to pay those debts off, through our policies, that was kind of a game changer for us. Because then like when you go to a bank and you take a loan through a conventional bank, I don't know how, when any of us have done that, how long ago it's been for any of us, but they tell you how much you're going to pay, when you're going to pay it, and what's going to happen if you don't pay them back, right? Where we pull that debt over to our policy, where we have control over it, we can decide how much we want to make, the payment we want to make. And, if we want to skip this month for whatever reason, if we're traveling, or whatever the reason is, that we skip making a payment this month, and then next month we make, a larger payment back into our policy loans, we have that control. So I just kind of paint that picture for our clients, so to show them that, they can recapture that control, and they can recapture their debt by doing that.
So two things occur to me right there, Sandra. One is that, well, you gave the example of travel. And if I'm not mistaken, you've recently been across seas and doing some traveling. So I'm a bit curious in the back of my mind about that, because I've seen the fantastic photos, of course, but I wonder, is there any connection there between, you deciding to travel and your experience personally with infinite banking? Is there any connection there? I suppose there is, but I wonder.
Yeah, so we recently took a 2-week trip to Ireland. Was our first time traveling to Ireland. We had a wonderful time. I don't know if any of you have been there. Beautiful country, absolutely beautiful country. And we really enjoyed our time visiting Ireland. And we traveled we went all around the coast of Ireland, got to see so many things. I don't know that we went through a travel agent. If I had planned it myself, I'm not sure I could have packed all that into, into 14 days, but they were able to do it. But yes, we actually traveled, and we paid for our trip using a policy loan. I think that's the direction you.
Yeah, that's what I presumed. I want you to be able to share whatever you want, but that's what I presumed, and I loved seeing the photos and you having a good time.
So yeah, of course credit card, because I wanted those points, I used my credit card, and then I took a policy loan and, paid off that to my credit card.
Right, because of that control that you had. And then here was the other thought that I had, and I appreciate you getting Sandra's thoughts on that, Joe, is I will use a book example anytime that I can. So I was in the same boat as Sandra in that I had consumer debt when I was exposed to infinite banking. And Nash points out in the book that 34.5% of the average American, so that means some are paying more, some might pay less, some are paying more than 34.5% in interest alone. So when people begin talking about rates, they're going to stop somewhere, right? They're probably going to say, well, I could get 10% in the market, or Dave says I can get 12, or I could do some lending and get 20%. Okay, but doesn't that pale in comparison to being able to have control, like Sandra's talking about, plus the opportunity to recapture up to an average of 34.5%? It dwarfs it. So, Becca, do you have any comments or feedback on the rate of return frequently asked question?
I have a couple of thoughts. One that I sometimes ask people is, who would win in a race, a cheetah or a black marlin?
A cheetah or a what now?
A black marlin. A black marlin's the fastest fish in the ocean.
Okay, thank you. I didn't know.
On cheetah all day.
Well, this is the answer. It depends on whose environment you're in. If you're in the ocean, the cheetah is going to be terribly slow, right? If you're on land, the black marlin can't even survive, right? So it's almost like when we try to compare these things, like, well, here's my rate here and here's my rate here, but we're talking about completely different environments. They play by different rules. And so it's like somebody in our group the other day said, it's like comparing apples to zebras. Yeah, it's just, and I understand that question because people are trying to find a mental file of where do I put this? What can I attach this to that I already know about to make it make sense so that I can know how to think about this. But I think it's kind of like we're stepping up on the wrong foot when we ask that question because it's just irrelevant. It's two different environments. And, I love, Sandra, what you were saying of just a personal experience, because I think that's what people really relate to. That's what makes it real. I would not have probably told you that I cared that much about having control of my money until we took a policy loan to remodel our kitchen. It's one of these things where we're going to replace the floor. Oh, while you're at it, we should do that. Oh, well, if we're going to do that, we should. Okay, we ended up just stripping it to the studs, completely overhauled. And I'm the type of person that I think in my pre-IBC, I would have been so stressed and penny pinching. How much is this going to cost? Okay, well, if we do this, how much is this going to cost? Because I don't know, can we afford to make those repayments on a monthly? But all the things. And I almost didn't even recognize myself because I was like, oh, yeah, sure. we had a ballpark budget, obviously. We're not going out and just throwing caution to the wind. But like within these, look, if we spend 20 grand on this kitchen, well, we can pay that off in 2 years or we can pay that off in 10 years. And it's okay. It's okay either way. And I did not realize how much that peace of mind, how much that would change the way I thought about a home remodel project. But it was huge. And I just think that what kind of value in that can you put on peace of mind? Can you put on control? Can you put on, like Sandra said, I can skip this payment next month if I need to, if life happens. So that was kind of a roundabout way, but that's kind of what comes to mind when I think about the rate of return question.
I love that. And I'm going to use that example of, now that I know what a black marlin is, I knew what a cheetah was. The environment. That's a huge theme. I know we could go on a deep dive right there. Of course, y'all would know this, but Nelson talks about in aviation, planes operate in an environment. Planes can't fly in a vacuum, and they're either going to have headwinds, no winds, or tailwinds. And financially, if you could get a tailwind behind you that moves you faster than you otherwise would have been able to, no matter what kind of plane you have or its ability, that environment influence dwarfs what the plane can do in and of itself. Beautiful. Okay, now I'll leave it open to anybody. Anything other on ROR, rate of return? Because I think you're right, Becca, that people are trying to associate whole life insurance or infinite banking to something that they already are aware of. Anything else there, or do you have a new frequently asked question? I'd love to hear either.
Well, I love what Becca said about how she remodeled her kitchen and she can pay that off in 2 years or 10 years. It's her choice. How fast or how slow do you want to go? It's you have control of that. It's up to you. So I love that you brought that up because that's really important.
Yep. And that's what I wrote when you were speaking, Sandra, I wrote control is greater than ROR. Because you can get an ROR when you practice infinite banking just on autopilot, just by owning a policy. It is an appreciating asset, period. Not an investment. Maybe that's a separate subject. Not an investment, but it is an asset and it does appreciate. So there's an ROR there. Great. But then you have that control of that financial environment on top of it, which is where it's at for sure. Okay. Anything else there?
Well, I'm sorry.
No, please.
I'll
go
hear
ahead.
people say, one of the things people have said to me, this is one of the reasons I wanted to bring this up, is we'll hear, well, I can get this amount of percentage in my high yield savings account. Okay, but you're going to pay taxes on that. You're going to pay taxes. You're going to pay taxes on that.
Let me play devil's advocate. I had this conversation this week with somebody, okay? Great saver. So obviously a great habit, right? She had put a significant amount of money away. Great. She's already beaten Parkinson's law. She's already beating her peers by comparison. We know that just because of the human problems. But let me play devil's advocate. So she says, all right, to me, Sandra, and I want you to respond to this, please. She says, well, yeah, but I don't mind paying those taxes because I'm earning on my money. So if somebody's in that mindset, what's your next question or thought, or what would you encourage them to consider?
Is, and I would be like, you're right, you are earning on that money and that's awesome. But as soon as you take money out of that account, that high yield savings account, you stop earning. You stop earning money on that money. Where inside your policy, you can borrow against your policy and you're still earning money on the money that you have in there. And get that rate of return that's so important, you know? And if it's really important to you to have this high yield savings account, put your money through the policy first, take a policy loan, then put your money in that high yield savings account, earn money in the policy and earn money in the high yield savings account, and then go back and pay taxes on the interest that you earned in the end, if that's really what you want to do, if it's really that important that you have that high yield savings.
I love that answer. Yeah. And it points back to that independence of, well, when you are your own banker, you can make any of those choices or any variation of those choices because, again, to your main point, you do have that control. But again, I think people get there once they understand that, oh, okay, when I pay premium, if I add that one step, right, to what I normally do, if I normally just get paid and then put money in my savings and then I earn and pay taxes or whatever, if I add that one step of put it through the policy first, I get a death benefit, I get a cash value, I stand to earn dividends, and I can still leverage that private system to go out and do whatever I want. Put the money right back in that high yield savings account. Joe, did you have a thought there?
Yes, I think it'd be helpful to distinguish the product from the process and say, this person you were speaking to that does a great job saving, whoever that is, fantastic job. Conquering Parkinson's and putting a great deal of your income aside, fantastic. They could put that in a CD and collateralize the CD and have a similar effect. They will similarly be light years ahead of spending the cash and losing the money, like Sandra and Becca were saying, permanently. It will be less efficient, but they could do that if they're, for some reason, don't like insurance, for example, but they still wanted to implement the same process. The process works independent of the vehicle or the platform. So really, once you get your mind wrapped around the process, that it's not about the rates, like Sandra was saying, it's about control. And Becca was saying about peace of mind and all these other benefits. If you get the process, then we're just saying which platform gives us the most benefits. And then it's a choice, like which one do you actually want? How many benefits do you want, really?
And what are some of those typical other platforms, Joe? You mentioned a CD, or ladies, y'all can say as well, CDs. That could be a thing. High yield savings account. Sandra, you were the one that introduced that platform, right? Are there any others that people would commonly mention?
Real estate paired with a HELOC.
Yep, I was looking for real estate in some form or fashion. Sure.
Anything else?
Yeah, so if you had like a taxable stock account or you're picking ETFs and stock, you can collateralize that. Basically anything that you can collateralize, including your FICO score. So if you go and get a personal line of credit, you can do something similar there. A lot of people will use that and coin the phrase velocity banking, which is actually from this gentleman. This is where that concept comes from. But it's essentially, he discovered a similar process later than.
Can I get a name, Joe? Sorry, would you
Nash.
audibly say that title and the author for me, please?
Sure. Each Gill, and it's how to own your home years sooner without making extra interest payments. There's two versions. One's Australian, one's for the States, United States. I bought the United States one, but
crikey.
Same idea. Yeah, crikey. But yeah, like a lot of people will use a HELOC, like he used the HELOC, but you could use a personal line of credit to do velocity banking. That's his invention is velocity banking, where you're using we'll call it unstructured debt to get rid of structured debt. Or a lot of people will say amortized debt versus simple interest debt. Not exactly right, but they use simple interest to get rid of amortized. That's velocity banking, but it's a very similar concept to becoming your own banker. They just don't have the balance left over, or the death benefit, or the long-term care, or all the other stuff that comes along with it.
Right. Okay. So I like that distinction, and we can go to both of those in turn, product versus process. Both are important. I think that the process is more important than the product, but then I feel like when you understand the process deeply, you're going to be looking for the ideal product to do that process with. So you have all these options on the table, of course, real estate, CDs, etc., for the platform, for the product. We all are obviously aware of what we believe to be the ideal product. And I'm aware of more than a dozen reasons of why, whether it's privacy or potentially having, protection against litigation, or whether it's guarantees or the guaranteed death benefit or net worth or legacy, and just on and on and on. So both of those are worth a discussion. We can go into either of those, so we can pin that or we can move on. We're on frequently asked questions. We're still talking about rate of return, and that's why I'm just trying to reiterate that for someone who's interested in rate of return or asking questions about rate of return, product and process are both important. Final thoughts there? Okay. Do you have another frequently asked question that's come across y'all's mind in this part of the discussion?
Why would I want to borrow my own money? That sometimes gets asked. Again, I'm trying to understand this. I'm trying to understand what you're saying. That doesn't make any sense. I put money into this and then I borrow my own money and pay the company the interest. And I think that's just a very common misunderstanding, that we're not borrowing our own money. We're putting our money into a contract where it is free to grow and compound for the rest of our lives, with all the added benefits that you guys just said. And then using that as collateral for a non-recourse loan for any reason, without any sort of approval process besides a signature, right? I mean, based on what you've put in, you can't get out more than you've put in, obviously. So I think that's a common misunderstanding. You hear that a lot with the naysayers and people. Well, this is so stupid. Why would you pay interest to borrow your own money? Well, it's an opportunity cost. That's something I did not understand coming into this, is that, it's always compared to what, right? If I go and spend $10 on lunch, if I would have saved that, if that could have grown and compounded even at a moderate interest rate for the rest of my life, what would that have turned into? That's just what I gave up for that lunch, right? And I mean, you can take it to an extreme, but if you could take everything that flowed through your hands and have that grow for the rest of your life while you use somebody else's money and pay them a little bit of interest. Oh, and by the way, you own the company, so that benefits you as well because you get a part of the profits. I mean, it's just it goes deep, and once, like Joe said, once you see it, you can't unsee it. And you move from this position of, well, how much premium do I have to pay, to how much premium can I pay? How much can I get into this? Because I see the benefit down the road, but it's not locked up. I can use it throughout my life. And anyway, I can get pretty fired up, but I'll stop there and see if anybody has any comments to add.
So what I would do is I would use maybe some of Joe's framework, and he can take it and run with it to lay over what you just said, Becca. And I love that frequently asked question. I think there's a product answer to that question, and I think there's a process answer to it. So y'all question my thinking on this. Okay. So the product answer maybe is something like, okay, well, look at the pros and cons of this platform, CD versus real estate versus, and the properly structured whole life policy from a mutual company, like you said, that allows you to pay or earn dividends as well. It just checks more boxes than other products, making it the ideal. So just people actually understanding what a policy loan is, and that it's not a loan, from their money, it's against this private asset that they own, is very different than, but that's the product answer. How about the process answer, where So I'll tell you, and Sandra, maybe you'd be familiar with this question. I remember hearing Brent say back in 2015, can you owe no man nothing? I hope I said that right. Or can you owe no man anything? Yeah, nothing. No, nothing's the word. And he really made me realize that, well, just because I own my land outright, and I did at that time, didn't have a mortgage. Is it mine if I don't pay taxes? No, it's not. Oh, wow. Okay, so there's still this maintenance, or there's still this overhead, there's still this cash flow that's going to somebody else, even though I own this property, et cetera. So he just really made me think with that good question about the process side of, or maybe even I could say the philosophical side of borrowing, right? Because Becca, people have strong feelings one way or another about borrowing. You got the Dave Ramsey's saying, you know, you'll go south if you do. No, he doesn't say that, but you see what I'm saying. I'm painting a fun picture, I hope. And then you got the Kiyosaki saying, well, I owe, you know, more than $1 billion, right? Well, they're saying the extremes. So what's really real philosophically or process wise behind that frequently asked question, you know? So I'm sharing my thoughts. Y'all run with it. Tell me, Sandra, what are your thoughts when you hear that question? Why would I borrow my own money? What sticks out to you?
So to me, it goes back to the control, borrowing my own money. Why wouldn't I want to put my money into this safe asset where I know it's protected and I'm making money, and then I can borrow against, I'm not really borrowing my own money. I'm borrowing against what I've created, this policy. I'm borrowing against it and using that money to do all the things and purchase all the things that I'm going to do anyways in life. And my money's over here compounding consistently every day, you know, just compounding and growing and I'm not interrupting that. If by borrowing my own money, I'd be interrupting that flow, right? That goes back to the savings, you know, using the savings account scenario, where if you take money out, you're stopping that compounding, you're stopping that flow of growth. And I don't know. I'd be curious to hear somebody else's thoughts on it.
Yeah, what are your thoughts, Joe?
I think when in that same vein where you're taking money out of savings, for example, if you were to purchase something, so you liquidate your savings to purchase and then replenish the account, if you're going to be honest and you're getting that 5 or 6%, shouldn't you owe yourself back that 6% or 5% anyway? So
Yes,
if we're being
sir.
honest, you're already doing it. Now, what we love, to Sandra's point, what we love about a savings account, borrowing from ourselves, which we're all already doing, is we're in control. And our default switch is to say, that sounds good, but I'm just going to put the $100 back. And they make the choice to rob themselves and not pay the 6 or the 5 extra dollars for the interest to get them back to where they should be. We love that control in that sense.
That's
and
a
if
good
you,
point. I think it's easy for people to do that. It makes it very easy for people to do that.
oh yeah. And now if take it the other way, if you borrowed to purchase and had to repay, the lender's not going to let you do that. If it's a third party that you don't control, they don't let you do that. So now you have to make those payments, or they come and take your stuff. So that bill becomes like a sting for people. So I think like on both of your examples, process and product, when you use the word loan, to your point, I think that's a negative word. I think that hits people right between the eyes, and they're like, oh man, just like my credit card, if I don't make the payment, they're going to take it away. I think, well, let me take a step back. So Becca, you were saying when you put money into this, or maybe it was Sandra, sorry. Somebody said, when you put money into this, it's like, really, you're buying a piece of property. It's not cash. It's a cash equivalent. It has a regular like price that you can get access to. in US dollars, but you traded your dollars for this property that is a contract. Like kind of like it's intangible property versus tangible property. Tangible being like a house or real estate or something like that. Intangible being contract, brand, goodwill, things like that. Life insurance is just a contract. So you paid for a contract, and that contract says it's going to increase until 120, age 121. If you keep waking up, it will keep increasing. Hard stop. It never goes backwards. It only goes one direction. So if we know that, and we just talked a little bit about collateralization, that's kind of the process. We have to go to somebody and say, here's our asset. Can you give us some cash equivalent of value of the asset to go do this thing so our property can keep growing, can keep increasing? If we know that's the goal, and we know this asset is perfectly only goes one direction, there's zero risk. Well, it stands to reason to underline what Sandra was saying. This is arguably the safest type of leverage, the most secure type of leverage the average person can get their hands on. Why wouldn't they want to do that? If we know we want to leverage and repay and let our money go, we would also want the control that Sandra and Becca were talking about and the peace of mind they were talking about. So if you start adding that all together, including what Becca said, that if you pay the interest, it goes to the insurance company, which you co-own. So when there's a surplus, they pass that back to you as a dividend. So the interest indirectly is going to a divisible surplus that improves your prospects of getting a dividend. So in a way, loosely speaking, indirectly speaking, the interest is fueling your dividend. So it's coming full circle.
It's a part of it for sure.
Right? It's part of the investments, which the policy loan is an investment of the insurance company, is part of the dividend. So it comes full circle. So it's exactly like your savings account. You borrowed it, only this, you also have the choice, which we'd recommend you pay it back in full, but you have the choice to not pay it back in full if you don't want. You can hold a loan balance as long as, indefinitely if you design it properly. It stands to reason, why wouldn't you want all these extra benefits for doing the exact same thing? It's just changing your form of capital from you gave your money to a bank to now you don't, like, those dollar bills are gone, right? The property you have at a bank is an IOU. They don't have the serial number. You could check the serial numbers that you put in the bank and then say, I want my $20 back. They're not going to give you the same $20. Right? It's the same process. They gave you an IOU and you say, can you change this into the cash equivalent? And they give you the cash. It's the same with stock. If you own stock in an E-Trade account, it's not in you can't call them and say, I want my shares. It's in street name, which means it's so the custodian can move them around behind the scenes. You have an IOU that says, we owe you this number of shares which have this value currently. We'll give you one or the other if something goes wrong. So in a weird way, like when you start to pull back the curtain, we're doing all this already. We just don't even know it with inferior products throughout our life. Once you start to see that, it's like, why don't we collect everything to the most superior product we can get our hands on that can still perform all these functions? Find a better one than dividend paying whole life. Yeah, show me a better one. I've looked.
So I just want to, one of the things that Joe mentioned, he compared to buying, purchasing a policy and compared that to buying a piece of real estate. So my husband and I have had this conversation. This is why I'm bringing this up. We, a lot of times, sometimes parents will, gift their children a piece of property, whether it's a house or whether it's just a piece of land or something like that. When they're old enough, hey, here's a piece of land, build your house, close to mine. Well, there's so many people nowadays that don't stay in the same location that they were born and raised in. Myself, just like myself, for instance. You give this child a piece of property, that's perfect for that child if they stay in that area and they plan to build their home there and never leave that property. But it's an asset to them, and you were able to gift this asset to them. But you can also give your child a life insurance policy that's also an asset that goes wherever they go in the world. If they end up across the country, they still have this asset. As long as those policy premiums are always paid, that asset stays intact for them, for their life. And that's a conversation my husband and I have. So when you brought that up, that just popped into my mind.
I love that. The asset that goes
example.
with you. Yes, absolutely. Absolutely. Well, I'll tell you one of the highlights that I got from what you were sharing there, Joe, about, why would I borrow my own money, pulling back the curtain, seeing what's really going on in all these different scenarios that are conventionally done versus what's possible with infinite banking. But maybe one of the strongest points that I'd like to just underline that you already said was, even if somebody borrows from their savings location, wherever that is, the natural human tendency is, even if they're going to do what the best people would do, they would only pay it back. The cost of capital, EVA, it's not taught, so it's not on their radar, so it can't be considered. People are not going to say, yeah, I'll pay myself 5%. Unless they've been exposed to banking, right, and infinite banking. That's not even a thought. That's not even on their radar because they're not even aware. So that cost of the capital is not even in those best conventional scenarios. It's not taken into account. And I think that's one of the strongest points that you gave there. Okay, I'd like to migrate y'all, if it's okay with y'all, and I've written down the frequently asked questions that we've covered so far and y'all's comments on them. I'm looking forward to visiting more. I'm sure it'll be a recurring theme. Here's the next thing. Best practices. Jesse, y'all's buddy, I would love to know some best practice that you've learned along your way of implementing infinite banking that you wish you'd have known sooner. What's something that you've learned about that, even because we hear this often, right? This is a common response from people about infinite banking in general. Where was this 30 years ago? Why didn't somebody, all right. So we deal with people that are, and it's a good thing. It's an aggravating thing, but it's a good thing when people feel that way because they do see the missed opportunity if they only could have known, right? But what I want to know from y'all is what's a best practice or some aspect that's ratcheted up or leveled up your implementation of infinite banking because you know it now. So I want to get this kind of information to people sooner, right? And I'd like to know what y'all's are for my own selfish reasons. So what's the best practice? Take a turn. And I'll tell you mine.
I can share. So I got two for you. Number one, don't sell the policy. Don't cash it out for a snowboard. Don't cash out a 20-year-old policy for a snowboard.
It took for all of our returning listeners, it took him 5 times of us hitting record before he said it before I could have an opportunity to jump in. Okay. I love it. I love it. If y'all don't know that, listen to that first episode. I'm telling you, on all of these folks, listen to their first interview episode. All right. What's the other one, Joe?
So the other one, like more practically speaking, whatever you're considering for the base component of your premium, it's probably too small.
Okay. So for the intro people,
the longer you're in the,
if somebody sees this for the first time,
okay, so,
well, and I'm hoping, listen, they're going to be returning viewers. They're going to know exactly what you're saying, but also for the first time listeners, just in case this is the first thing they ever hear about infinite banking, put it out there to them in that way as well.
Okay. So when you purchase this property, this contract that is life insurance, your obligation, your only requirement is to pay a premium. So in exchange for the premium, you get all those benefits we've been talking about. The premium can be made up of a couple different things. First, your baseline coverage, the baseline death benefit, the guaranteed death benefit in the contract. The second thing is temporary coverage within the contract. The third might be riders. So that might be add-ons to the policy that kick in after certain events happen. So if you get, heaven forbid, something happens, you're disabled and can't work anymore, a rider might trigger that pays the premium until you're 65, or depending on the company, that can be different. And the last thing,
terminal illness,
is
chronic illness, those types of things could be some.
Yep. Examples. And then the last one is paid up additional premium, paid up additional death benefit. Of those, most people try and spend as little as possible towards the base component, and they try and put as much towards the paid up additional death benefit component as possible. Like if they could get it like 0.00001% towards base and the rest towards PUA, man, they would jump at that at a heartbeat. And I would say the longer you're in this, you realize you want a lot more base than you first originally thought.
Awesome. I think that could bear more explanation of why. So if you just gave us another line or two then on that, because I agree. When people know more, they want to do more. But why would somebody consider that? Why is that a best practice that you wish you'd have known or implemented or realized sooner?
Because it guarantees your contractual right to absorb and control more cash flow throughout your life. So you're able, the base premium you pay sometimes up to age 95, maybe 100, depending on what carriers you're using. So you're able to control that cash flow all the way out until 95 and 100. Whereas if you cut it off because you're 65, or that's when the policy, I don't know how much people will know, but like goes paid up at 65. So you stop, your obligation's fulfilled. So they adjust all the values because you're saying to them, I don't want to pay any more premium. Give me what all my premium has bought so far. And then we'll let it go from there. That's what kind of paid up. It's paid for, you could think of. If you pay for the policy at an earlier age, you've lost the ability to add money to this, to pay the premium, which decreases the future values, all of the future values. We're back to that idea of opportunity cost. That means all your future generations, those dollars are just floating away. They're going to somebody else now because you've cut it off. Is that making sense? I don't know if I'm simplifying that enough.
Will be less. Yeah. If I repeated that last part in my own words to confirm that to affirm that to you, I would say, yes, you're cutting off your guaranteed right to pay a cash flow into this private asset. So yes, inherently the values that could have been will not be as great as they could have been. I say it like this, I guess. People never anticipate. I don't care when it's retirement age, passive income, time of life. They're 100 years old. They still want to make deposits at a commercial bank. Why would they ever want to stop making inputs, right? Or contributing to, or making sure that cash flow such as they are in their lives is going to their private banking system. Nobody's upset about deposits to a commercial bank. So I'm not upset about making premiums to this private bank that I have. That's what occurs to me.
I like that. I think if you think about the sensation retirees get when Social Security or their pension hits their account, just automatically plops into their account. They love it. But when they shuffle from the left pocket to the right and pay the premium, they don't seem to love that, even with all the extra benefits and the values increasing at a multiple and so on and so forth. For some reason, it doesn't have the same. It's like they think they got that one for free and this one not for free. When all you're doing is moving from the left pocket to the right.
Right. You have to respect your own money as much or as more than what you're respecting the conventional bank's money.
Yeah,
Absolutely. That's a good one, Joe. I get it. It makes sense to me. That's your best practice. Ladies, what's a best practice you wish you'd known and implemented sooner?
Well, I'll just kind of piggyback off of what Joe said. I didn't, when we took out our first policy, like I understood a little bit, but I didn't know all the ins and outs, right? And so my policy has a 20-year term rider on it. And I looked at it the other day. I hadn't even really remembered that detail. I pulled it out and I just thought I was going to pay on this for at least 30 years, right? Because when you're going into this discussion with the agent, right? Everybody kind of has their guard up. I would think that's human nature, right? What's their angle? Are they just trying to get all my money? What's going on? Why do they want me to make this bigger? Why do they want me to make this longer? Oh, they're going to get paid more of it. All these things. And I had a great agent, don't get me wrong. But I went in with the mindset of what's the least I can do? What's the least I can do to make this work? And so now I'm, say, 4 years into that policy, and I'm looking at that 20-year term rider saying, dang it. Dang it. That's only 16 years away, and my ability to pay premium is going to be drastically reduced because I was afraid to capitalize, right? That's one of Nelson's rules. Don't be afraid to capitalize. And I thought I was following that because the total number to me looked really big. Like, I'm not being afraid to capitalize, but the minimum, my base, was fairly small. And that made me feel good in the beginning because I was like, look at this. If I can't do all that, I don't have to, right? Okay, there's some value to that. But now that I'm in it a few years and we're using it and I'm seeing the benefits, and like Nelson says, more caught than taught, right? All of a sudden, I'm looking at that saying, dang it, right? I mean, it's going to be stinking efficient at 20 years. Like, this thing's going to be rolling, and I'm going to have to drastically cut back. Now, could I start another policy? Sure. But then it's going to take me 20 more years to get back to that point. So I wish I would have started with more base, with a little bit more efficient use of my death benefit dollars. But I didn't understand. And I was where I was. I made the decision I made based on the information I had at the time. And I think that so many times it's so much easier to sell a policy when you say, hey, look at how much cash you're going to have. This is amazing. You have like instant liquidity, instant bank, and that looks great. But then you don't realize what you're cutting off at the other end, right? When that compound interest curve is getting real good, all of a sudden, by the way, you can't put any more in. So, yeah, it's not the end of the world. Or I'll build my next one differently. I'll say that.
Joe, you had a follow up there?
Yeah, I'm going to piggyback off of Becca, who's piggybacking off of me. No, I said this a while back, and it strikes people odd. It kind of captures what she's saying. If you can pay if you're anticipating of paying the maximum PUA, remember the components we talked about. If you're thinking you're going to fill that up, that is a glaring issue that you don't have enough base. That shocks people when they're like, wait a minute, but I'm going to put $5,000 in and I'm going to split it up this way. I'm like, you don't understand what you're doing just yet. That's not a good enough study of your cash flows and the long-term ramifications of that decision. Otherwise, we would end up kind of where Becca's at. Like, whereas if she took a moment and maybe, I don't know what it would, like, if we could take her brain now and put it in her brain 5 years ago when she was signing the dotted line, she would say, wait a minute. Why? That's going to drop when this is going that way. No. Hold on. Let's adjust these numbers a little bit. That's okay. The short-term thinking jumps into this idea that we want so much flexibility early on, and the trade-off, the opportunity cost, we forget about that of the flexibility. Whereas if we were prudent and measured our cash flow appropriately for 4, 5, 6, 7 years, and had a really good plan to fund this for 4, 5, 6, 7 years, that policy is actually extremely flexible. And you don't lose the opportunity cost of insurability that gets added to these policies that are really tiny bases that have huge term death benefits that are going to go away. It's like instead of using up all that insurability, if you had more base, you could effectively absorb the same cash flow and now change the dividend and surrender a little bit of this, but you didn't lose any insurability. So you could still expand your system. Like she's saying, Becca's saying she could start another policy. Well, if she made doubly bad move where it was like she used all her insurability, because that is limited for each person. So if she used up all her insurability to get as much money as she can in year one, and now she has to wait for that thing to fall off, what could happen in 20 years? Sickness, you're going to get rated. It's just going to be a less optimal situation for her if she started out differently.
I will say, to that point, Joe, I mean, I'm 4 years in. I was super preferred 4 years ago. And I've had some stuff, like it's nothing huge, but I guarantee you I'm not super preferred anymore. No way. And you never know you never know what's gonna happen. You never know what life's gonna throw at you. So
all right, my highlights, and then we'll go to you, Sandra. Thank you, Becca, for saying out loud the things that you did a few minutes ago about people's thoughts when they're first talking with an advisor or an agent about this, because people do have their guards up. I had my guard up, to some degree, some more, some less, but literally, thanks for saying those words out loud so that people can hear and think, well, oh, okay, I'm not weird. That, so I appreciate, I appreciate that. We're people too. We've been there too. So we know. And then Joe, everything that you were tying up there at the end where you're talking about insurability, everybody needing to maximize and have, a custom plan for them so that they are being as efficient as possible with the insurability that they do have. So Sandra, to you, any feedback on that from them or a best practice from you?
I thought that was great. I thought that was great what they shared. I do have some best practices. I'm going to kind of go a different direction, and I'm going to talk more about the family. So one of the things, like prior to using infinite banking, I was not really a huge proponent of putting insurance on children. Like I just was like, yeah, kids are healthy. What do they need life insurance for, right? They got a long life ahead of them. Knowing what I know now, being in this industry for 12 years and talking to clients every day and talking to people who have children or even young adults who, have reached their early 20s and maybe are uninsurable. I know it's really important to put life insurance on a child as soon as possible. So as soon as you can put insurance on those children, grandchildren, you want to put insurance on them, even if it's a small policy, because you're protecting their insurability. Once they have that policy, no matter what happens later in life, if they become uninsurable, they still have that life insurance as long as those premiums are paid, and it can't be taken away from them. So I talk to people every day, and I've encountered some families where they, have a child that, something developed and they become uninsurable. And it's a terrible thing to go back and tell somebody, hey, I'm sorry, your 20-year-old, we can't place insurance on them because of this. But if they already had that policy from when they were an infant or a young child, that can't be taken away from them because they have it, no matter what develops later in life. Joe wants to say something. I see
no. A question for you. For the audience, like, can you explain what that means? Like, if something happens and I am now uninsurable, what is the insurance company basically saying about my health, my mortality?
I'm going to let you answer that. Since
yeah, Joe, answer your own question, sir.
Oh, you listen up, Joe.
Tell us what sticks out to you about it.
Yeah. So if you are uninsurable, if the insurance company will not give you insurance, what that means is you're so far outside of the risk pool for them that they can't justify adding you to the risk pool. And that's probably a nice way of saying your natural mortality is expected to be less than they need to be in the pool. you're not going to live as long statistically. This isn't a guarantee, but statistically, you're not going to live long enough to fit properly in the pool to share the risk. You're going to need benefits earlier than other people.
He said that
earlier
more eloquently than I could have.
Well, I'll tell you what I'm envisioning as he describes that is I'm envisioning that chart wherever it's at in the Becoming Your Own Banker book where Nelson's saying, here's what it is, right? And it's changed over time, like every decade or whatever, the tables are updated, but it just is what it is. It's a bell curve, you know. Some people graduate early, and to Sandra's point, if you're in that case, nobody likes to think about it. I mean, it's always interesting to me that people, you know, refuse to talk about that stuff. And okay, do what you want to do. I want you to be as independent as you want to be. But there are repercussions to that line of thinking, right? So you could be on this side of the bell curve. Somebody in your family could be on this side of the bell curve. Why not have the guaranteed protection right out of the gate and the guaranteed ability for them in the future, which is the more likely case, to be able to do banking for themselves with this private asset that you can get for them. But there will be some people on this bell curve. Most people hit the top of the bell curve, right? And then there are some people that are going to be on the other side of the bell curve, which is where it's great to think that we could own these private assets till we're 121 years old for people like me that are going to live to 120. It's great, right? So it allows you to do both, right, Sandra? You can have the guaranteed protection for everybody in the family from the get-go. 2 weeks old child, let's start an application. If you understand this concept, let's start an application and get a policy on that child, right? But you're also banking on, see the pun I put in there? You're banking on the probability that they're actually going to be able to use this policy in the future for infinite banking as a member in your family as well.
And you know, and just to go back to what Joe was saying there, so you know, it's not always a health reason that the person can't be insured. There can be other factors that a person can't be insured because of. And I don't want to go into any of those details. But you know, it's like I said again, it's a difficult thing to tell a parent that their young adult child can't be insured. But if you place that policy when they're younger, you know, then they ease into adulthood. They've got that policy in place that you can change the ownership on it if you choose to. At some point, you can make, you know, if you're the owner as the parent of this child later on, you can change the ownership, and the child can take over the ownership on the policy. And what a gift to give your child, right? I mean,
Sandra,
I'm sorry. I was just going to add that, you know, I'm probably older than all the rest of the people on this call, but I have grandchildren. So one of the things I did a few years ago was take policies on my grandchildren, and they're just young guys. They don't, you know, we're teaching them infinite banking, but they don't totally. I mean, yes, kids' minds are very, you know, they're very much more flexible than ours are. They're going to learn a lot faster than we did, but they don't understand the whole concept yet. But when those kids when they're old enough to buy cars, they're going to be able to finance their own vehicles using their policies. You know, I didn't know about this when my kids were that age. So they had to go get a job, you know, go to McDonald's, get a job, and you can, you know, save up your money and pay for a car. You know, these boys are going to be able to take policies or take loans from their own policies, finance their own vehicles. Or if that's not the choice, you know, later on, start a business, build, you know, buy a piece of property, pay for a wedding, pay for college. You know, that's what those funds are there for. But they're healthy now when they're young, and we don't have to worry about what happens later, you know?
Absolutely. The one thing that I would say is that in conversations, not just for children's policies, Sandra, but, and you know this, but with adults, the insurance companies, and to Joe's point, they're evaluating risk, and it's not just health. So I guess I want to say some encouraging things here and some clarifying things. Somebody could be denied for their driving record. Somebody could be denied for their criminal background. Somebody could be denied for different reasons. And to that point, and I've talked with ex-felons and different stuff, of course, that get exposed to this idea and they want to implement it. So my encouraging word is that there's a chapter in the book, and it's short because when Nash talks about uninsurability, he reminds us that, well, just because you can't get a policy on you because you're outside of those parameters that Joe was describing doesn't mean you can't own a policy. And then here you come to appropriate measures like taking policies out on children and such, which would have been a natural progression anyway. Even if you had got a first policy on yourself, you would have naturally moved to business partners, family members, etc. anyway. So I guess I just want to encourage people that just because you're uninsurable for whatever reason, because it does happen sometimes, doesn't mean you can't do infinite banking. But it's also, good for people that are vetting this idea to know that the insurance companies are evaluating your life, and that's going to include your finances and your criminal background or et cetera. For you in a DWI, DUI, depending on what state you're from, how they term it, they care about that kind of stuff because they're evaluating it all because it's whole life insurance that we're using. Great. I love hearing those best practices from y'all. Everybody has the benefit of hearing them. Me, if I gave y'all a tactical one, I remember when I first learned about convertible term insurance, and I thought, and I wouldn't have grasped it, right? Like I could have had my agent and mentor say, well, at the first meeting, hey, Jesse, you should also consider a convertible term policy that you can add on to your system in the future. You can have a bigger death benefit locked in now. That way, if health does change, I could have had all those benefits. But 4 or 5 years in, maybe, of doing infinite banking, paying off debt, financing vacations, all kinds of fun stuff with whole life policies, I learned about this idea that, well, you could have convertible term insurance and pay low premiums, relatively low premiums, have a bigger net worth and protection amount right out of the gate, but also have a guaranteed contractual right to be able to convert that into a new branch of the family banking system in the future. For me, that was one of those big tactical, you can do that? Come on. I wished I'd have known about it sooner. And I use that more with clients now because I'm aware of it. So that's why I want to mention that one here. Beautiful. Best practices. Frequently asked questions.
Convertible term.
I brought up.
Oh, I'm sorry. I was just going to add on.
Go ahead, Sandra. Ladies first.
I was just going to add on to what you said there, Jesse. Convertible term is really a good idea if you're not ready to put the funds into a whole life policy right at this time, but you're in really good health. But a good example was Becca said she rated super preferred. Go get that convertible term policy and then later on slide into a whole life policy with it.
No, I'm glad you added it. That's another great scenario because there's more than one. There are many scenarios that we could, and that's a good one where, somebody might see this idea. And I was on the phone with a guy in Puerto Rico. He's from the States, but he's in Puerto Rico yesterday. Money's tight. Former military, had a big career change recently, but he also found out about this concept. So he's talking to me in a moment where money's tight and he's not ready to do a whole life insurance premium. He's not. And we talked through that. But does that make convertible term that much easier for a first step? Yes, it does. So I'm glad you brought that up. That's a good one. Any other thoughts? Somebody else started to jump in. Joe?
2 things. I think like what Sandra's saying about the convertible term, what you were saying about the convertible term for the audience, when he was saying it's contractually convertible, like you don't have to do the medical anymore. It takes that risk off the table. So when he's saying you lock in the death benefit, it locks in the health rating too. And it takes financial underwriting off the table. So you don't have to prove, like the next policy you get, you don't have to prove as much when you're trying to get that policy established. It's much faster. It's it's after 90 days, it's a signature. And within a week, you have a new policy. It's done.
You just want to know like how much time you have to convert it. So not all convertible terms are fully convertible. Like if you have a 10-year term, it might not convert up to 10 years. It might only be 5 years, it might be 7 years. You need to know that. So that if you're planning to convert it, you want to make sure you convert it in that time period that you're allowed to without having to go through underwriting again.
Yeah, love that. And the only other thing I was going to say is underlining what Sandra was saying about generationally buying policies. Man, if you ever see one of these, if someone ever gives you an illustration or you're looking at your own policy illustration, scroll down to like year 20 or 25. If you could start there how many more people would do that? That's the gift you're giving your kids, essentially.
Mhm.
If you're buying this policy on them and plan to give it to them, maybe when they get out of college or that age, roundabout age, around 25, to hand over the reins, the keys to the castle, it's like they're starting, like Becca was saying, this thing is humming. This thing is really efficient. When they pay $1 a premium, the values go up a multiple of that. It's like, that's a really cool, like, they're going to say, why didn't you get me more?
And structured correctly, right? I mean, you want, especially when it comes to, kids policies, you want to make sure, like Joe was explaining earlier, you want to have a good base on that policy so that 20 years later, you've got some really amazing growth going on.
Yeah, because children's policies, even if you do emphasize the base, because they're insured typically less than their parents for obvious reasons, there's still only a certain amount of money you can actually pay in children's policy premiums. Right. So if you got a higher base, you're guaranteeing that you can pay a greater volume of capital into that size of a policy later on. I appreciate both of y'all. Joe, thanks for fleshing out those other factors of convertible term that I didn't verbalize. So thank you for covering me there. And then Sandra, there was something you said that gave me a good thought. I was going to circle back to it. Now it's leaving me, but I wanted to tell Joe thank you. And then you said something that gave me another thought. Best practices, child policies, convertible term. It was something around convertible term. Oh, I remember what it was. It was just a general disclaimer because you just said it just a second ago again. People should be familiar with what they have. And for all of our clients, I know that I'm not overstepping my bounds if I say, if you're not on our calendar at least once or twice a year, you should be. Okay. Well, we've dropped the ball somewhere. We should have ongoing conversations. And if you're a new client or a prospective client, I know that, I will commonly look at policies that prospective clients already have. Maybe they've got a policy through work, the military, something that they've probably got, et cetera. And sometimes y'all know this, sometimes they'll say, oh yeah, I got a whole life insurance policy. And I'll say, well, email it to me. It's a free service. I'll look at it for you and it'll be some kind of universal policy. And I'm like, okay, it's in English, y'all. I mean, I get that there's a lot of pages or whatever, but this is what you got. Did you know this is what no, I didn't know that's what I had. I said, well, here's the year that it's going to lapse. Did you know it was going to lapse, in this number? No, I didn't know. Okay. So yes, to Sandra's point, be familiar with what you've got. And also structure is super, super important. Love getting y'all's best practices. That's good conversation. So some of my other thoughts of things that we could cover, and y'all let me know, and this could be a pause if you want. Does anybody have to dip out? Okay, I think we can get close to landing. Maybe we can cover one more subject. So here's the next subject that I'm curious about. And again, all these subjects that we're bringing up, frequently asked questions, best practices, we can return back to these. And we're going to have other folks on here with us so that we all have the benefit of their best practices, et cetera, as well. But let's talk about maybe, and Becca perhaps touched on this earlier inadvertently, some misconceptions or some outright myths or misunderstandings around. And so I'm saying this knowing good and well that I've got a playlist on my channel where I cover myths, mysteries, and misconceptions around infinite banking. All right. Because we were talking about Dave earlier and some things that he might say, right, Becca? Around whole life insurance, infinite banking, what it is, what it isn't. So I'd love to hear from y'all in your conversations with clients or in your own personal story. Was there some myth? Was there some misconception around whole life insurance or infinite banking, money in general, whatever that you could share for everyone else's benefit and just talk through your thinking process? Well, I thought this way. Then I was exposed to this book, this podcast, this whatever. And here's where I'm at today. Anything like that occur to y'all as I described that?
I have a question that comes up sometimes when I talk to people, and I'm not quite sure where it comes from. I'm going to be honest with you. I'm anxious to hear what Joe and Becca and Jesse have to say about it, to see if they run into this too. So I will sometimes talk to a client who wants to do a monthly premium. And then for some reason, I don't know where this thought process comes from. Maybe it's only the people that I talk to, but they think they can put in they'll put in their first month's premium and they're going to be able to borrow their full annual cash value right away within the first month. Has anybody else
Got you.
encountered
All right.
that where you had people think that?
So I'm gonna go first.
I'll go first because mine will be quick, I think, and then I want to hear from Joe and Becca as well. I had a phone call one time, y'all. I had a phone call. I call this gentleman. I'm prompt, almost always. I'm prompt, right? I show up. Hey, this is so and so. Is now still a good time to talk? Yes, now it's still a good time to talk. Okay, awesome. Well, my name's Jesse. I'm from North Carolina. I've practiced this for going on a decade. I'm married. Got 3 kids. I'm going to be an open book. Ask me anything that you want. How about we start with, once I make sure they've either seen a video presentation or read the book, right? My first question to them is, well, what are your questions? This guy asked me one question. He said, are you telling me that if I pay a premium, 1 month's premium, right, Sandra? If I pay my first premium, I can leverage the death benefit? I can leverage that $500,000 death benefit or that $1 million death benefit or whatever? And I said, no, sir. He said, okay, that's all I want to know. Hung up the phone on me. That's the only time it's ever happened. But he obviously was thinking something along those. Now, he was thinking about, wait, I can leverage the death benefit and not the cash value. So he was wrong, obviously, on that. And you're asking about the cash value that builds up. So I just thought, I don't know, maybe just for your entertainment purposes. I was mad, y'all. I was like, man.
I've had that question. I've had that question too. So I've had that question too, where people.
But did they hang up on you when you gave them the answer?
So I can borrow that much, and it's like, where are you finding that information that you're thinking that your thought process goes that direction? It's like, it's almost like they think it's a subscription program. Like, that's what I'm like, well, if I pay this subscription each month, then I can take loans of this magnitude, and I don't know where that comes from. I don't know if you guys have encountered that or not with anybody.
I have not. I think I'm reluctant to use this example because it can go off the rails pretty quickly. But it's a lot like a mortgage in that you don't have any equity to re-advance yet. Like, you just started, it's 100% leverage. The mortgage equals the purchase price. So there's no, what else are you going to borrow? You have to pay it down a bunch before you can borrow the amount you paid down, right? Like, loosely speaking.
I think that's the closest example that the layperson could relate to and understand. It's a good one.
I think that's one misconception that I had early on when I was first learning about this, when I was proving it wrong, of this whole thing of, well, the insurance company just keeps your cash value when you die. Why would you save all those years and accumulate all this cash value and then they just keep it? It's the biggest ripoff ever, right? I didn't understand that the cash value and the death benefit are the same thing at different points in time, right? Like, this is the death benefit is what it's going to be. Like, it's ever increasing, but this is where it's going at 121. And the cash value is the cash equivalent, I guess, of that at different points along that trajectory. And so actually, when I did hear the mortgage example, that helped me kind of click. Oh, okay. So as I pay off my mortgage, I gain equity in my home. And then I can, if I wanted to, I could go take out a HELOC based on that equity, not based on the sales price or the valuation of my house, because that hasn't happened yet. Right. But the equity that I have in there, kind of like a line of credit, that helped me to wrap my mind around that, because I think that's a really common argument that you hear, is that, gosh, the insurance companies are evil and this is just why the worst scam of all time, right? It's fleecing the middle class or whatever it is. But it was just came from a lack of understanding, right? And I think that as we talk to clients, like, they don't have to know everything that we know. And I, for one, certainly know that I have a lot more to learn. But they need to know that I can explain it if they have that question. Like, I'm not going to go into every single detail about this policy, but I think that hopefully my clients have the confidence to say, but I know that if something comes up that I can ask, and there will be a reason. This is not just arbitrary. They didn't just pick some numbers and this looks good on the illustration, so let's do this. No, there's a reason for everything. And there should be, right? There should be a reason there should be a strategic reason between or behind every decision that we make or that our agent helps us make with these policies.
Awesome. Yeah, I would say, Sandra, that sometimes it's with my first consultation call with a prospective client. Sometimes it's on our second call that we might get to that question of, hey, how quickly does the cash value build? And that's where I certainly reiterate, well, here are your options. You get to choose, the mode that you're wanting to input into this private banking system. So you can choose to do something monthly, quarterly, semi-annual, annual, and you're obviously aware of that. And that's a great time to either go ahead and proactively answer that before they ask it, unless they just already have asked, well, how quickly does that cash value build? So that I can say, well, yeah, if you're making monthly premium payments, that cash value builds up monthly. And if you can, and it makes sense for you to make an annual premium payment, then go ahead. It allows you to bank sooner rather than later to the full value that you can access and leverage against it, et cetera. But yeah, that's a good one. That's a good one. And then Becca, you're again inherently bringing up another one, which is that the insurance company keeps your cash value. So you verbalize that for us. So Sandra or Joe, let me kick that over to y'all. When somebody brings that up to you, or that's a question that they have for you, well, does the insurance company keep your cash value though? What's your response to that?
So I just kind of explained to them that the cash value is a portion of the death benefit. So it's basically an advance. The insurance company is saying, okay, here's your death benefit, and this is how much of it you can use now at this point in time. Basically, what Becca said, I'm just using different words, where
Yep, I'm just trying to give you that's what I want. I'm trying to give you an opportunity. I want Joe to be able to do that.
Yeah.
Sometimes just that word change helps people.
It's just an advance on your death benefit, basically. But it is all part, because I agree, I've had people say that to me as well. They think the death benefit and the cash value is two different things, where they think they're going to get both, when they pass away. And trying to explain to them just that that's a portion of the death benefit. That cash value is basically an advance of the death benefit. If you don't use it, it's all intact when you pass away.
Anything else there, Joe?
Yeah, so I try and head this off by kind of educating, like, remember, this is why I said I don't really like that example too much. Like it's good to get that concept, but it's inaccurate. If we're being accurate, I go back to what is whole life. Whole life is a contract. And in the contract, there are benefits within the contract that you get for paying the premium. Two come to mind. The first is the death benefit. The second is the endowment benefit. So the endowment benefit is what happens way out in the future at age 121. At that point, if you live to 121, they give you a check, cash, equivalent to the value of the death benefit. So between now and 121, that's what the cash value is. It's the today's value of that endowment benefit. Now it happens to also coincide with, it equals the death benefit. So a lot of people will say it's the current value of the future death benefit. But it's two distinct benefits that contractually meet in the future. I try and impress upon them that, because if you pass, that's a triggering event where your cash value becomes the endowment, the death benefit, to your beneficiary. So your beneficiary can get it, or you can get it if you live long enough. I think I was going to, like, the myth I was going to talk about is, or misconception, was probably, what is cash value? It's not an account. It's not invested in the general fund of the insurance company. It's none of those things. it's not invested per se at all. It's a contractual increase each year that has to happen so the endowment equals the death benefit. Like the cash value, today's value of the endowment must eventually equal the death benefit. I think a really good explanation of that, I forget which video it is, like Ryan Griggs, if you've ever seen his Mechanics of Whole Life series. I'm pretty sure, I'm confident he walks through that to explain the different benefits and what's happening within the structure, the contractual structure of the of the agreement. So it's I like, Becca, what you were saying, points in time, the idea that it's that future value, but today's value of it. I've heard it said another way. It's the value that the insurance company would pay you to walk away from the obligation of the death benefit. Like the cash out, I give up value, pay me, I'm out of here. Let's end this whole arrangement type thing. The exit strategy, like all that. Yeah, I'm reluctant. Like again, I'm reluctant to use those other examples because I think it's short-term thinking. It conveys an idea to somebody, but it plants the wrong seed of the next thought of what that could be. So when I said it was a mortgage, it's like a mortgage. You're thinking it's equity in the property. It's not. There's no market value variability to this. It's an appraised value that every day the insurance company wakes up and says, Jesse, we'll give you $100,000 to walk away. The next day, Jesse, we'd like that off our books. We'll give you 101,000. Jesse, 102,000. Like that's what's happening.
Deal or no deal, right?
Deal or no deal. It's a constant offer to walk away. No deal. Don't take the deal, people. Don't take it.
No matter
I
how
don't care how good that snowball
Looks, keep that policy.
Yeah. Oh man. Burn.
I love it.
Yeah, I fell for it. I took the deal and I regret it.
I love where this conversation is going. Okay, so those are good misconceptions. What is cash value? I also like being very literal and remind people, because I'll use analogies, I use descriptions and close examples, but a contract is a contract. It's a piece of paper. You say you'll do something, I say I'll do something. That's it, in black and white. It's nice to be grounded there on it's a contract. So when it comes to these misconceptions around, well, what is cash value? It's in the contract. I love it. Good. So actually part of your answer too, though, Joe, makes me think of something else I wanted to ask y'all, which is, what is a resource? So you mentioned Ryan Griggs by name. Okay. I've watched his Mechanics series for the real analytical people, for sure. It's for anybody. It's for anybody who's considering buying whole life and implementing infinite banking. It really is. But he's so articulate in writing also. Other than Becca, he's somebody else who comes to mind other than Becca. Becca's an authored writer in this space, but Ryan does as well. I love his stuff. So I'd love to ask y'all, would you recommend some podcast, some book, some resource that's helped you in your infinite banking journey as a pro, as a consumer, either one?
Besides
Durham talents.
Come on. Thank you.
I was going to say, besides Becoming Your Own Banker, I think we've all read Becoming Your Own Banker.
It's the place to start for sure, and it's worth rereading too, isn't it, Sandra? I do try to reread it at least once a year. I'm always trying to read new books. I enjoy reading, but it's worth rereading for sure. No, I appreciate you mentioning that for sure.
I'm a reader, so I've read several books. In fact, I'm reading through Garrett Gunderson's What Would the Rockefellers Do for the Second, the newer version. He just came out with a newer version of What Would the Rockefellers Do. I'm reading through that book for the second time.
Awesome. I think that's a great recommendation. I think I was 1, 2, 3 years into implementing infinite banking when I had a friend recommend that one to me. So yes, I would highly encourage that one. Great. Any other resources, Joe, Becca?
This is one that really helped me when I was first starting out. A Path to Financial Peace of Mind by Dwayne Burnell, and he has a follow up now. I think it's called Financial Peace in the 21st Century, something like that. Same author, but it was just very. If you're more show me the numbers type of a person and prove this to me that way, that helped me kind of see it from that way. Whereas becoming your own banker maybe is more conceptual. This is the human problem, which are, and both are valuable, in that. But that's one that helped me early on.
Beautiful, beautiful. Joe?
So I've already said read Becoming Your Own Banker at least 4 times. Slowly highlight, mark things up, ask questions. I think this is a great one.
Yes.
Building a Warehouse of Wealth. This one, The Case for IBC, is another really good one. This one here, How Privatized Banking Really Works. Yeah, again reluctant to say go anywhere else. There's a lot of misinformation out there in the big wide world, or at least incomplete half-truths out there. So I would wrestle with the original book. If you need to get the seminar, if you need to find somebody who will use the book as a way to teach you first, then go venturing out to all these other things. Some of these aren't, Nash was part of some of these books, but
yeah, so let's jump in here. I hate to interrupt you again, Joe, but just for the audio listeners, Joe held up Nelson's second book, Building Your Warehouse of Wealth, because that was Nelson's second book. You held up The Case for IBC, Robert Murphy, Carlos Lara. Of course, they're giving credit to Nelson in that book as well. How Privatized Banking Really Works, also Carlos Lara, Robert Murphy. Excellent reads. For the audio listeners, those are worth reading and rereading. So speak more, Joe, but I like how you said wrestle with becoming your own banker. I appreciate that.
So I like, speaking from my own Jacob moment, wrestling with, you got it. You have to exhaust yourself in this material. I would encourage you to try to disprove it. When you think you have it disproved, find somebody who knows. Contact Jesse, contact Becca, contact Sandra, and say, here's what I came up with. This is better. And just come to it with an open mind. Because we all think we're all stuck in the way we're thinking. And so we tend to use old methods to analyze things. This is something new, like Becca was saying earlier, much earlier. You're going to try and use an old, something you already know to figure this out, and you can't. It's like when your parents try to get you to ride your bike for the first time. It's just something new you're gonna have to wrestle with until you actually see what's going on. That would be my advice.
I love it. Well,
then the podcast will.
For sure. Appreciate you.
Sorry. Yeah.
No, I appreciate the recommendations across the board.
I like that Joseph said about staying with going back to the beginning material, the Nelson Nash material, and what came from the Nelson Nash Institute, and how he said there's a lot of information out there that could lead you in the wrong direction. And I totally agree with that. You have to be careful who you're listening. Pick a voice that resonates with you and follow that. You have to be careful. If you're out there, you're listening to everybody, you're trying to take in everything about infinite banking from all different sources, you're going to confuse yourself. Because not everybody uses the same terminology. Some come at it from different angles. There's some practitioners, like Joseph said, that, are not looking out for the client's best interest, maybe. You want to make sure you're with the right person. So you definitely want to pick a voice, follow that voice.
I love that. There are enough great people out there that you can find who you jive with. You can find who you're, of one accord with. I would confirm that with you. I'd underline that with you, Sandra. There are enough great people out there doing things the right way that you could find who you get along with, and who best works for you, both for working with or studying behind or whatever. And there are also so many great people out there, the good ones, because there's plenty of bad. There's plenty of misinformation, but there are enough good ones that actually, and we're in this space, and I'm actively trying to let iron sharpen iron every chance that I get when I'm driving or have a spare moment. And I'm trying to listen to lots of places, or enough places, that I can't do it all either, So we're even all limited on our time of where we can too. So that's great. Well, the resource I would say then is just confirming again what you mentioned, Sandra, which is the Nelson Nash Institute, even to this day, 2024, has been releasing never before seen footage from R. Nelson Nash himself, which is just so good to be able to see that you can go right to the source verbally and visually and whatnot, beyond his books and all these other great resources. So I love this. Y'all, I'll tell you, I've got, and y'all have mentioned to me some more subjects and topics that we could cover. I believe what I'd like to do is hear what you would like to leave the group with. Of course, I'll be able to share any of y'all's contact information in show notes and things of that nature. This is an open invite for future conversations, because I do have more things that I would like to ask y'all in this format, in this roundtable setting. So I'm looking forward to that. I appreciate your participation here, the value that you're bringing to me and to everybody that's listening. There's so much more I want to cover. But what final thoughts or what parting thoughts would you perhaps leave people with?
I would say
Ladies first. One of you. Thank you, Sandra.
Be open-minded. Open your mind to the possibility that there's another way of handling your finances. We've all, when infinite banking was introduced to me, I was in my 40s. I'd been conditioned for a very long time to do things, the old way. I'll call it the old way. And there was a mind shift for me, and I had to be open-minded. If I chose to be closed-minded about it, that was going to make it a whole lot more difficult. I was like Joseph. I dove in and read a lot of Nelson Nash's material and learned as much as I could, but I still had that period of having to change the way I was thinking. And so I would just say, be open to a new possibility. I think that's the best place to start.
I love it. And between now and then, Sandra, just again for the audio folks that are perhaps just listening to this, where could folks find you?
So you can find me in a couple different places, because I wear quite a few hats. My husband and I, we have Banking with the Fries. So you can find me at Sandra at bankingwiththefries.com.
And
I'm
that's
also
FRYS.
FRYS. And, or, I'm also a team leader at the Money Multiplier. So you can also find me at Sandra at themoneymultiplier.com.
Fantastic. Becca, parting words, parting thoughts, encouragement to folks? Other than read your great book?
Buy Beaver Bankers. No, I'm just kidding.
Absolutely. Buy two.
To go off of what Sandra was saying, if you get into this and it seems like it feels upside down to what you've been taught, or inside out, or backwards, or any of those things, you're on the right track. like Joe was saying, just embrace that, wrestle with that. And I think what you'll find is that it's going to take some time, because it is a perspective shift. It is a different environment. There are different rules, right, to how money works in this other environment. But if you will hang with that and continue to wrestle with it, continue to ask questions. You know, I liken it to when I was first learning about this. It seemed like when you wake up from a dream, and at first you're like, oh yeah, I remember the dream, and then you go to tell someone about it later, like, I mean, wait, now what? I've lost it. What have I felt like that with IBC? I would read something, and I'd be like, oh, I got it, and then 5 minutes later, I don't have it. Like it was just like this fleeting thing, and it's strange, right? Like I want to understand things, and I want to understand it quickly. And I think our human nature is, if we can't understand it quickly, then we write it off as that's not right. And my encouragement would be embrace that in between, and be willing to ride that out to its logical conclusion. And as we learn to rethink our thinking, as we learn to renew our mind, we form new neural pathways of things we've never learned before. That's a good thing. Even if it ultimately just leads you to a conclusion that you don't want to do this, great. But you've learned something new. And you have a broader understanding of how money works and how money flows and all those kinds of things. So yeah, be open-minded and be okay with the journey.
I love that. Becca, you just verbalized something that I'm now remembering I felt over those first couple of years, which is the slipperiness of those new concepts that I felt like I got, and then I felt like I didn't. That, I don't know, that's just the word that comes in my mind, that slipperiness of it. Thank you for verbalizing it that way. That helps me reflect back on my own experience. Yes, it's that way. Yes, it is. All right, where can folks find you?
Well, kind of like Sandra, I wear different hats. I have a website at salientssolutionsibc.com. So you can find me there, or I'm also work with the Money Advantage. So I have Becca at themoneyadvantage.com as well. Yeah, and my book Beaver Bankers is on Amazon. So that just kind of came out of a heart to want to teach my kids, and not really feel like I could hand them becoming your own banker, at 8 years old. That's probably not going to work. But how do we start talking about these concepts in a way that we can have these conversations as a family? So.
Absolutely. Yeah. My family, I've told you this, that we've read it and enjoyed it. And now I'm looking forward to introducing that to our family meetings, because we've got nieces and nephews and cousins, all over the place. And it's a great segue for them. So I appreciate you for that work. Joe, last words, encouragement, thoughts?
I go back to the struggle with this, wrestle with this. It's going to be slow at first. It's going to be frustrating at first. Becca, I love that idea that, like, if you're thinking this is backwards, I'm missing something, it's upside down. Why, you're on the right path. I would also offer this idea that Nelson leaves clues throughout the book. It's designed for the average person to read. And the concepts that he shares in the book are designed around the average American family. So this is not something that's so like out of reach for millionaires and billionaires, and it was designed for everyday people. And it's written so everyday people can find the breadcrumbs. One example of that was he talks about a play and characters of the play. If you can keep this in your mind as you're reading it, it'll be really helpful, because he talks about like a consumer mindset, a borrower mindset, someone who owns the bank and their mindset. If you could think, like, he'll give one example, but if you can think through it from different angles, you'll get closer to the correct answer faster, if that makes sense. But everything is in there is deliberate. It's all methodical. The examples he gives in the book are actually extremely conservative examples of implementing IBC. Maybe we can talk about that later. But if you're trying to use your calculator to prove this, it's going to be really, really frustrating. And that's going to be your first instinct. There's so much more that doesn't show up on the tables and the illustrations that he provides. You're going to have to look for, like, read between the lines, so to speak. You're going to have to think through things. He designed it deliberately to make people think. He's not going to give you all of the information up front because he wants you to skip over certain details and then think back like, well, why was that like this? And that's part of the learning and the struggling process. So please, that's what I mean by take your time, read it multiple times, struggle with the original work. It's designed for that. There will be a point, like it'll happen all at once. And then when you really see it, you'll forget the whole struggle that you it'll feel like you always knew it, and like, oh yeah, of course, this is what we do. It'll be really tough to go back and think, well, why was I doing it that way? I can't even justify it now.
It's true.
Yeah, so that's it.
I love,
That's all I got.
it. I love it.
Well,
That's all
I
I
can't
got.
say thanks enough to all of y'all for being here, facilitating this conversation with me. I'm looking forward to the next time. So for everybody that's tuning in to this roundtable conversation, let's see your questions or comments below of things you'd either like us to expand on, things you'd like us to revisit, dive deeper into, things that you would like us to cover, because Sandra, Becca, Joe, they're going to be back. We'll have other guests on to add to these conversations. We have more topics that I'd like to cover as well, but I want to hear from you. So do these guys. Their contact information will be below, where you can reach out to them for their books and their phone calls and all those types of things to be able to connect with them. Again, like Sandra said, look for that voice that is most helpful to you. But we appreciate you being here. I hope you learn to live and leave a lasting legacy. Have a great day. Take care.